All right,
Love it.
good.
Garrett rocks it.
Yeah.
Akeem, Roger, Garrett, welcome. We'll
Thank you.
get going here in just a minute. And Akeem, you're dialing in all the way from Austria. Is that right?
Yeah, that's right.
All right.
Oh,
Excellent, man. We're glad to have you
welcome,
here.
welcome, Akeem.
Thank you very much. Welcome you too.
Garrett, Garrett,
why
hello
don't
there.
we just go ahead
Good
and
morning. Good to see
get
you.
started here. I think Laura, if I got your permission, should we go or should we wait just a little bit? You tell me.
Go for it.
Okay. All right, guys. So we've got a lot to cover today. We got, of course, the Fed coming up a little bit later on. Fed decision at 2:00. I think the comments afterwards at 2:30 by Powell will be much more informative. But we're going to talk a little bit of sector rotation since we got Akeem here. Talk about that Fed decision, how we that, and then we got a couple other topics, maybe some value plays to cover. So, Akeem, say I'm pretty sure that most people are unfamiliar with you. Why don't you just take a few minutes before we get going here, introduce yourself, your style, and let's start off the conversation that way.
Okay. Thank you very much for your invitation. Yeah.
Mhm.
Well, I'm working now as a trader for about 20 years now, and I really tried in all that years lots of things, lots of stuff. I traded news. I tried to make things with news regarding to be the first on the place. Yeah, I have the best news and such stuff, and I always try to catch the holy grail. Yeah, and the thing what I really saw, which worked quite a lot in the last years, is sector rotation. So the only thing I'm watching is primarily the market. The market has to work as always. And secondary, I want to look where the big money is going in, the money flow. And we also always have sector rotation. Some sectors go very good, some are awful. Last year, we had a couple of good trades in oil stock, gas stocks, solar stocks went really cool. And everything with technology just went down the whole time. So I'm always watching at least once a week where the money is going in, which are the strongest sectors in the market. And there I try to find the leaders. So I don't try to catch.
So with that, that's the so last year, yes, we had this. The oil was about the only energy stocks were about the only thing that really worked, at least for the most part. How do you see sector? What do you see happening in terms of sector rotation now? What do you expect during the year? And Garrett, Roger, I'd love to hear you guys' opinion on that too.
Well, yeah. I'll if you don't mind, I'll just give you my 5 cents on that.
Yeah, that'd be great.
Okay, well, and Akeem, I'm also very, very big on sector rotation. As a matter of fact, I hope it's okay if I share my screen with you guys real quick. Just kind of show you kind of what I'm looking at real quick here. So one of the major things I look at is I look at which sectors are outperforming other sectors on a relative strength basis. So one of the things I look at is over a period of time of 6 month, 3 month, and 1 month, which sectors are leading. And Don, you're absolutely right. Last year was just all energies, all energies. But what I'm seeing right now actually is I'm starting to see basic materials outperform energies, and industrial stocks were also gearing up a few months back when the defense stocks before they broke down a few weeks back. So now I'm starting to see more basic materials, which is really impressive, and it's actually overtaking energy. So I'm thinking that's going to continue, and at the same time, I'm thinking that the communication technology and discretionary, which is a lot overbought right now, is going to come down with the Nasdaq being right at the 200-day moving average.
So I look at sector rotation a little differently than I think everyone else does, because I'm just focusing on relative momentum in terms of the performances between the two. And when you see the materials rallying, it makes perfect sense, right? Dollar's getting weaker, China's reopening. These have become relatively good. They're cheap. I mean, you look comparatively, materials and energy are still actually cheap compared to some of these other entities. But I think conditions right now are very tricky. We're going to talk in a minute. I'll show a chart when we start talking about the Fed. Communications, cyclical, defensive, and real estate are at their strongest levels that I have seen since the beginning of that sell-off in August, around the August 21st date. So if we get a rollover in this market, I think that's where the money's going to come out first. One of the other things, utilities has been chopping around the last couple of days. Utilities, when we have seen big sell-offs in the last year, utilities is one of the first things to go.
Interesting. Oh, did we lose? Oh, okay. Garrett, was that your comment? I didn't know if you got cut off there or not.
Did I get cut off?
No.
Okay. I didn't know if
we're all set.
Comment there.
No, I was just changing. I was just looking at my screen so I could show a screen of the utilities while Garrett was talking, kind of just illustrate. That's all.
Great.
Yeah,
Okay. So you think so your contention is that utilities will signal a sell-off if we're headed for another leg down in the S&P.
I mean, they've been a major guide this year. I mean, you look at the strongest. You go back to January 13th. You look at the April 6th sell-off. You look at the big sell-off from June 9th. You look at the sell-off from September. And what was important, we started a big sell-off around the mid-August. That's where we were in these really, really strong conditions, but the market really didn't go until September. And when that broke down, it broke down. So when I see that type of pattern, that double topping pattern on the XLU, that was a little concerning to me because the market was really weakening at that time. Capital was pouring into the utilities, and then it just broke down, and it broke down in a very pronounced manner. So if this goes, I think the XLU will push back to around that $64 level. But I'm also going to provide you the base case for why we might be in a different, a totally different environment than where I thought we were a month ago. We'll talk about that when we get to the Fed.
Yeah. Let's pick that up in a little bit. And I think as you say that, as utilities as a leading indicator, there's not a great deal of uncertainty in utility cash flows, right?
Correct.
Future cash flows for that. So it really is a comment on overall broader market valuations, right? The Fed hiking, inverted yield curve, low earnings generally, all of that prices, that would signal, utilities would pick that up as lower prices because discounting at a lower rate, those more certain cash flows, right? And the opposite would be true. So I can see your why you're looking at utilities as a good indicator. I like that. I like that analysis. Now, Akeem, what are you seeing right now? Sector rotation. To me, I've always kind of viewed that as a mystery, right? I kind of look at the macro, and then if there's individual things, but frankly, I've never really been able to figure out sector rotation. So I'm hearing what you guys have to say about it.
Well,
so how do you see it?
At the moment, we've got very, very, very strong gold, silver, copper stocks, which weren't leading last year, but they are leading now at the moment since a couple of weeks. The problem is, I don't think that the dollar to euro, I always watch euro to dollar, and the euro is very strong at the moment. Yeah. And I think we get a bigger pullback in the next week. So gold and silver should come back. But I think this pullback might be a good time to buy some gold and silver stocks. So that could be quite an interesting sector. A leading sector last year were steel stocks like Steel Dynamics and US Steel. And Steel Dynamics STLD is running absolutely crazy at the moment, but I think the valuation is a little bit too high at the moment. What I saw in the last couple of weeks is that semiconductor stocks went back to the leading sectors. We've got quite a lot of very nice stocks out there like Rambus, RMBS, Infineon, PI is a very, very nice stock to Lattice Semiconductor, LSCC, or a stock which I bought last week and made 20% one couple of days was AEHR, also a very, very nice stock out there. And what I'm watching there is, first of all, the ETFs like the SMHs, what you gave up there. And the second, I just try to find the best 2, 3, or 4 growth stock out there in the sector. And I think these are quite of the best stocks out there. The leaders of last year, like AMD, NVIDIA, and so aren't quite that strong at the moment. So let's look how these sectors work on. But semiconductor was quite strong. And what I also see, I think it's quite a good opportunity regarding this rate hikes in the insurance and also financial sector. So if you take a look on XLF, we're just now breaking out there. Or KIE is also an insurance ETF, which is quite interesting at the moment. I'm in both.
So on the financials there, what's your so with, you said with rate hikes and it's looking like a strong sector, but is that based on you think the Fed's going to pause right now and profitability come back to the banking sector and it's a bullish call for financials, or do you think that the inverted yield curve is going to keep eating into earnings and interest income and that sort of thing, and it's negative? I wouldn't. What direction were you looking at from the on XLF?
Yeah, well, normally when the rates are high, it's quite good for the bank stocks. So that should work off in the next couple of weeks. But I don't think that this thing on the rate hikes when they stop, yeah, and the rates go down, probably 2024. Will be a big deal for the stock market. So when we look back in the last 10 or 20 years, every time when the Fed started to slow down and get the rates down, the stock market went down in the first stages, I think at least 20% or so. So we had that 2007, 2008. I think we also had it 2001, 2002. So that could be a problem maybe in the end of 2023, 24.
All right. And hey, Roger, what do you so just to kind of wrap this up before we step onto the Fed, what
I wanted to actually, I'm glad you asked, because I wanted to give you I wanted to just comment on this. Akeem made a comment, says that with rates going up, it should be good for financials. The interesting part about it is that a lot of people think that when interest rates go up, that means the banks make more money. But the truth is the banks make money on their spread.
Yes.
They make money on the spread. So they don't really make more money with interest rates going higher. They actually just, the spread increases one way or the other, but that spread is always pretty constant. So I don't know if that's the case right now. But technically, I do agree with Akeem. I do believe fundamentally, I don't believe that financials should be going up. I think financials should be going down. And we'll get into that when we talk about the Fed and all that. But technically, I agree with Akeem 100%. They are going up, and they're looking actually really good. And it's, I usually when I place a trade or when I give a stock pick, I love when the fundamentals and the technicals agree. This is right now is probably the biggest period where I'm seeing a complete diversion between a lot of what I'm seeing technically and what I'm seeing fundamentally. No, and that's a big red flag, because right now the NASDAQ is literally sitting at the 200-day moving average right there and doing this. Come on. Let me sucker you in as much as I can before I take you down for another dump. And I'm pretty confident in that scenario working out. So again, to summarize, fundamentals, technicals completely moving in the opposite direction. When that happens, big red flag. And overall, I think the fundamentals are going to win this game over. But I'm kind of liking playing the techs right now in the short term and all of these things that Akeem is talking about. You can't ignore it. I mean, you got to trade what's in front of you, especially if your time frame is short term. So it's a very interesting position that we're in, Don. I'm glad you asked me that.
Yeah, no, the banks borrow short and lend long, right? So long-term rates have gone up, right? But shorter-term rates have gone up much more. So their borrowing costs are much higher than they were in that inverted yield curve. We'll see what that tells. That dichotomy, I think that's a great, that kind of mismatch of that polarity in views between technicals and fundamentals. You can say polarity of views in politics, right? You can say polarity of views between the equity market and the bond market together as one, which they are now together, and what the Fed wants them to believe, right? I've never seen anybody fight the Fed. Garrett, I know you think they're not fighting the Fed. They're going where the liquidity goes. But what do you expect out of the Fed decision today? How's it looking? What do you think is going to be most important to focus on?
25 basis points. Cool. No reaction. 235. What ends up happening between 235 and 237?
Yeah.
Powell says something and algorithms go insane. And then ultimately that's what leads to the market the rest of the day. I don't know why it's been this way, but it's happened almost every single Fed meeting going back to the beginning of last year. I want to share my screen real quick, if that's all right.
Yeah, please do.
Please.
Okay. So I wanted to show you this chart. I don't know if you've been reading what I've been writing over at Hub, but this is when I came on last month and I said 32.48. You always have to update your expectations because you get new data, right? So for the last year, we have had this trend of lower highs and lower lows going back to January, and we have traded in this channel, right? It was largely guided by the 200-day moving average, but you could see lower highs, hits this bottom. That's where, things are volatile. That's the time to hold your nose and buy. We rally up here. Then you have this sell off, and it's just been shopping that way. That is the trend line that would possibly take us back to 3,400. But something else has happened, and it comes right here in October. And this was around the time that the Federal Reserve said we're probably not going to sell mortgage-backed securities for a while.
Yep.
Look at this line now. Look at this trend line coming up, and look at this wedge, and look at what is going to have to be decided in the next 2 weeks. Yeah. Is this market going to continue this uptrend, or is it going to break down? And the reason, and I didn't see it, but I see it now. If you look at the National Financial Conditions Index, we are expanding on risk, credit, and leverage at the fastest pace we have since 2020. And Stanley Druckenmiller back in 1988 said, we focus on liquidity more than anything. Liquidity capital has been in this system. It's been increasing in this system. Even as the Fed is cutting its balance sheet, Congress is putting capital into the markets. The Treasury has its general account. They've got $300 billion on the sideline. I don't know how they're going to allocate it, but it seems to be part of their extraordinary circumstances. And that creates this. And this is the S&P 500 trading against the balance sheet of the S&P 500. There's been this direct causal relationship between the S&P 500 and the Fed going all the way back to when they first started engaging in this wild, amount of capital dropping in the market. Then it broke last year. And as you can see, when this trades at this lower level on the histogram, the market had been a screaming buy. But now look at this. For the first time, going back to effectively December, we have now started to trade once again at a higher level than the balance sheet. So that to me is why I say I think the focus today on the Fed's balance sheet will be critical. If we look back at what happened in 2018 as the Fed was cutting its balance sheet, draining liquidity from the markets, obviously that impacted the bond markets and then spilled over into the broader equity markets. But I look at this chart as well, and I say to myself, oh, this completely explains this line right here because capital came back in and it has been moving up. So what I think might happen is you might move down to the 3,900 level, but we are not going to know if it is a continuation of this trend, the original one from 2022, or if it is the start of something new from October that can create lower highs and lower lows. And that's why I'm range bound. I think this could scream to 4,300 and take us up to overbought territory and then dump after sucking people in, as Roger had just described. Or we do get that rollover and we start to peel back and reality sets back in, because I have not seen a market this detached from reality probably since 2007.
And I just want to,
it's interesting you talk about that. The Fed is actually way behind on this quantitative tightening, right? Whatever the number was, it was at 80 billion or something in September that they were going to do a month.
Hold on.
They're like half that pace, right? So they haven't done nearly the amount of tightening that they suggested to the market that they would. That got priced in. They clearly disappointed. Those financial conditions, have definitely eased significantly along with GDP. All that and a lot of other stuff is kind of why I think the Fed is, 25 basis points is most likely what they're going to do. But I wish they would channel some Greenspan and come out with 50. A nice surprise. Do that. What's all this talking and communicating and having a Wall Street Journal guy in your hip pocket? What is it? What is this crap? Right? Bunch of snowflakes anymore. Let's get Greenspan back and shock and awe. Not that I think that he will, but I think in the back of his mind he knows he has all this other wood to chop. Weaker dollar isn't good for it either. He could that language, that opportunity, that talk at 2:30 is where he can come in and say something very kind of ominous and threatening. Akeem, what do you think? And then Roger, I want to definitely get your 2 cents. Akeem, you're muted. There we go.
I just always also want to share my screen here with you.
Please do.
Let's try this one. So you should see now my charts regarding S&P 500 weekly chart. I'm also watching this whole stuff here with lower highs and lower lows, and I think the most important thing now for the market when we look especially on the S&P 500 index is this 4,100 area. We tried last year to make here a higher high on the weekly charts, but we weren't able to hold this higher high only for 2 weeks, and then we went down again. So I think the only thing I'm watching now is, first, are we always as bullish as we can to break out of this 4,100? So that would be a buy signal. And the second thing is we need to hold this 1,400 level. So if we move up to, let's say, 4,200, 4,300, when we get back again to 4,100 and we break down again, so we've got a breakdown failure, and that would be the most bearish theme I think the market could make in the next couple of weeks. So it all depends if we break out above 4,100, if we can hold this level or not.
Yeah, we're right on the cusp. All right, Roger, what do you think?
I personally, I want to go ahead and share my screen again real quick. I want to show you something interesting that I'm seeing now. Keep in mind what Garrett was just talking about, how we're right at the 200-day moving average, and the same thing for the SPY. The SPY's not all that far away, and the divergence we're seeing in the Dow versus the SPY right now in terms of the levels are very, very high. So if you look at the SPY, we're pretty much doing the same thing. We're kind of sitting right at the 200-day, a little bit higher. But I want to show you guys something interesting. If you look at the individual sectors, and I'll talk about the Fed. If you look at each individual sectors, and if you look at right now the communication services sector, it has 88% of the stocks trading above the 50-day moving average and only 52 above the 200-day. Now, this has 2/3 of the FANG stocks in it. And typically when it moves up to a certain level, it cools off and it just can't go much higher. Now, we go back to 7 years on this. Look at where we're at right now. So the odds are, and we're talking about Netflix, we're talking about Meta, we're talking about, just to give you an idea, the kind of stocks we're talking about here.
Yeah.
We're talking about big market cap.
Yeah.
Big market cap. Meta, Alphabet, Netflix, T-Mobile, AT&T. So this sector right now is extremely overbought. And I mean extremely overbought, most overbought in 7 years. And at the same time, as we're seeing the sector as overbought as it is right now, we're literally seeing the QQQ at the 200-day moving average. So it would be virtually impossible. It would be virtually impossible for the Nasdaq to go higher with communications going lower. And the communications is the most overbought it's been in 7 years, and only 50% of those stocks are trading above the 200-day moving average, which is exactly what you're seeing here. So if that's not a recipe for a pullback to the downside, I honestly don't know what is. To me,
that's good. Yeah, no, that's what I thought. I'm sitting here as you're saying this, I'm thinking, what would it take, right? Telecom, that sector has come a long way, right? You basically got all your streamers and your cable access and internet providers and that sort of thing. What would it take to make the market really love them even more at this point, at such an extreme level, right? I mean, what is it that in terms of either discount rates or sentiment or whatever, and it's really would just be either some sort of short squeeze or just a very near-term pop, right? Some kind of speculative that got over his skis. I just don't see anything that makes that sustainable.
No. Maybe just and just to kind of just to revisit back, to bring this all back home, maybe something like the Fed doing something totally unexpected and rates 0.2 faked into the market.
I'm sorry, Rush, you cut off there for a second. You were
Sorry.
saying the Fed do something unexpected.
Yeah, the Fed doing something totally unexpected, like not raising rates at all during the meeting today, which I don't think is going to happen. I think they're going to go 0.25
It'll be
or
4,800 before you know it.
yeah, or you know, something really, or Powell saying like saying something totally unexpected, like we're done for this time and we're going to be just wait, which I don't think any of that is going to happen. But I think it would take something really unexpected, or maybe earnings from this point on just being completely, which none of these things are going to happen. I'm just giving you, you know, some potential things that could happen, but there's very few catalysts. There's very little what I'm seeing right now that would make this market go higher. And again, it's very worrisome and it's very, very vulnerable. And at the same time, only 50% of stocks are showing extreme overboughtness in the 200 days. So the 200-day is saying, hey, we're about as high as we're going to go. We're about halfway done. And the 50-day is just screaming up. And I've seen this song and dance before. I want to see the vulnerability in the 50-day, not the 200-day. I want to see the 200-day is like a foundation. The 50 days like a ceiling. You know, you could make a really strong, you can make a ceiling out of diamonds, but if that foundation goes, it's going to go. And that foundation looks like it's going to go. So I think 0.25 for the Fed. I think Powell's going to give us the same song and dance. What we're doing is working. The core is getting better. We're going to continue doing what we're doing. We're not, and maybe down the line, sometimes in the future, we'll re-examine. But for now, we have to continue doing this approach. I think that's that's the narrative we're on right now, and I think that's what the market's expecting.
Yeah. You know, if the Fed shocked on the other side, if they actually turned tail, right? If they didn't hike, or, you know, any kind of language around that saying we're done. That's just a signal. That's a signal the market's been dying for, is like, hey, but the easy salad days of the last 12 years are back. Let's go easy money, you know, get those valuations up. And, you know, we're looking at 4,600, 4,800 on the S&P and then we got a real problem with inflation down the road. But that's great. We'll see. Okay. Well, now with that, let's talk a little bit about there's what kind of individual opportunities are out there. What either is it on a sector broad based, and you know, Garrett, I think I'd love to hear a little bit about I got a sneak peek. Laura sent me a sneak peek at your latest newsletter. Yep. Loved it. Some really good insights. Without telling too much, I used to work about right during the Great Financial Crisis. I was at a community bank as their chief investment officer. You know, I learned a lot. There is, you know, the number one lesson I tried to teach them was, you know, look, there's no such thing as local markets for the price of money. Correct. You know, number two was, you know, if the Fed starts cutting rates right here, meaning they were at 5.5% when I started, and going into 2007, I was pounding the table. Let's start working on some interest rate hedge strategies here. Otherwise, you guys are toast. We finally got some money on the books, and that helped a lot. But I learned a lot from that. Tell me what you're seeing, and how do you think there might be some opportunities out there?
Well, again, when it comes to banks, one of the key things that we're always focusing on is really a longer term trend. And the longer term trend goes back to the 1980s. Back in 1987, there were 15,000 banks. Today, there's 4,500 banks. Wasn't bank failures that drove that number. It was consolidation, right? 3 to 5% consolidation going back to 87. And in this environment, we've seen a number of new trends kind of emerge on the back of the Jobs and Tax Cuts Act that made things a little bit more friendly for banks to engage in M&A activity. We're seeing a lot more opportunity ahead because, look, in this environment, you want to be in a space where you have companies that are trading for less than the sum of their parts. So the only way to grow your bank for deposits is you either live in Florida, where I am, and people move down here from New York and New Jersey, and they bring their deposits with them, and that allows these companies to do the lending, or you have to buy another bank. And that has been a very core trend going back for 35 years. So we have in this environment, we're looking for financial institutions that are conservative in their lending, have good management, and ultimately will probably sell their business. Remember, in the banking world, people under 40 don't want to go work for a community bank. They want to go work for Morgan Stanley or Goldman Sachs. They want to have that card. A lot of the executive boards of these community banks are in their 60s and their 70s, and they don't have a transition plan. The transition plan is an exit. So this has been something that I've worked on and consulted on for a while. And we were just looking out at a conference that was in the desert out in Phoenix. My father-in-law visited it, and it was called the Acquire or Be Acquired Conference, because that is the single biggest trend in the community banking space. And more importantly, there are other things like cybersecurity costs. You have a company like JP Morgan spending hundreds of millions of dollars on cybersecurity. A little tiny community bank with 13 to 15 branches can't afford this. So we have another company already in our portfolio that pays about an 8.5% dividend. Just kind of walk you through like what we're doing right now, looking at value. Right now, key thing is this. I'm going to share my screen real quick. So Tactical Wealth Investor, we launched this at the begining of January, and hopefully I'm sharing my screen correctly.
Yes.
For the most part.
All right. Well, slideshow. That's what we need. Sorry. All right. So we're focusing on value and income-based strategies. And our value focuses on strong shareholder-friendly businesses, looking for good banks, looking for good companies in various spaces, selling for less than the sum of their parts. We focus on banks that have a tangible book value under 1. So that means if the bank has $1 million in the vaults, and this is just a hypothetical, but it's trading for $800,000 on the public markets, it's trading at 0.8 times tangible book value. And there are many of these banks. You have to go through all of them and qualify them and look for the strong ones. And on the income side, we're looking for good balance sheets, great boards, great businesses with stuff we need, energy, shipping. And this was our portfolio to start the year. So we had a fertilizer play that's up 16.2%, a lithium play that's up 7.9%, community banking play, it's down a little bit, but it's got a 7.9% dividend. And this company, if and when it does its thrift conversion, has 123% upside. So you buy this stock right now, you hold it for 7.9%, and then you wake up one day and the deals are done. They return the cash to the shareholders, roughly $14.25 up to $33. And then on the income side, we're up 3.3% on our oil and gas with 11.1% dividend. Private equity energy was up 5.4 with a 5.5% dividend. And this closed-end fund on the MLPs that is up 7% and is trading at about a 16% discount to its net asset value. The company we added to start the year was a shipping company in a very niche industry in the ice breaking business. It's up 14% to start the year, 6.5% dividend that is secured. It's not like these other shipping companies. So now we're looking at an environment.
Real quick there, is that a play on the Great Northern Passage?
That's exactly what it is.
Upping the shipping, or where's that come in?
That's exactly what it is. This is the busiest time of the year for the Northwest Passage. And these are companies that are able to set much, much higher rates than traditional dry bulk. Plus, this company is diversified, so it didn't just have too much exposure to the coal business. It's a relatively small amount of their shipping was linked to coal. And even though coal's kind of coming back, but yes, they are engaged in the ice breaking business. They command higher rates, and the stock has taken off since January 6th with this nice secure dividend. So now as we're in this stretched market, now we have to kind of shift our perspective a little bit and focus on value where value exists. So in this community banking space, you've got this company that's trading for 80% of the sum of its parts, 79% book value. The company is growing its book value. It is buying back stocks. It is improving its metrics. It's got an older board, and there's a long-term appreciation in consolidation. So when a company like this gets taken over in a very attractive market for consolidation in the New Jersey, New York area, this isn't going to get bought at the sum of its parts at 1. It's going to get bought for about 1.5 to 1.6 times its tangible book value.
Yeah, so there's lots of parallels, right? So back in '87 was the S&L crisis. You kind of had this they got put in a bailout zone, and then that period from 90 to 94, there was a banking desk on the investment bank I worked at, and they cleaned house on all these small banks. At that time it was S&Ls and rolling up the strategies there for that, up through 94. That was just a remarkable play. And there was another wave after the great financial crisis. The bank I was at got bought out 2-3 times after that. And yeah, you see those valuations, they bottom at around 0.8 or 0.5, and then they end up saying at 1.5 to 2, right? So it's Correct. A great play, and they're so and nobody's even thinking about this.
No,
I mean, it's unlikely for the stock even to react in a big sell-off in the near term, right? Because they're just so
correct.
They're so under traded, right? So there's one other thing that I think is an interesting part of this. I was reading your report. And when you go, if you were to go work in a small bank or an insurance company, and part of this is because they're a regulated business, I think, but the technology is appalling, right?
Yes.
I remember pushing documents still around in baskets and actual paperwork everywhere. But the opportunity for somebody to come in and invest a little bit of capital in them with know-how, and now that you have artificial intelligence. I don't know if you guys are familiar with Upstart Financial, but they're basically doing Upstart Financial does AI underwriting for banks. And that's exactly what they are. It's like turnkey solutions for these kind of community banks, and makes them very competitive. And the stocks got hammered in this sell-off, of course. And along with banks, they have an interest rate sensitivity as well to heightened rates. But the point is, that type of AI is ready for prime time. It's a very vertically oriented AI. It's not trying to do everything for everybody. It's focused on a problem. It's learned how to do the problem, and that's the type of scale. That's how, through an acquisition, they can compete with the big boys. And there's just a general fragmentation anyway. People much, the just banking at Bank of America or the big four banks or whatever, I think is counter the current trend. So lots of interesting stuff in there.
So we'll be releasing this today at Tactical Wealth Investor at 1:00. So
nice.
You want to click the link and again, you're not going to worry about whether or not what's going to happen in this market over the next 24 hours, next 3 months. We are focused on about an 18 to 24 month period. We're focusing on companies that are deeply undervalued, companies that, when we do finally get this economic recovery, they can blast off. And we're playing into trends that this banking consolidation trend, and the way these community banks trade, they trade at a steep discount, obviously, but they also have a very low beta compared to the S&P 500. So you should not even care what's going on in the day-to-day these businesses. The goal is here, you're going to wake up in the next 18 months, and this stock is going to be worth 2 times its value. And the downside is parked by the fact that it's trading for less than the sum of its parts.
Yeah. Yeah, I think the key there is with those low beta stocks and uncovered stocks. The other part to that is a bank that didn't manage its risk effectively or not. And I know that's something that you pay very close attention to, because that can change. That can change the situation very quickly. Anyway, Akeem, Roger, that's been great. Hey guys, any parting thoughts before we close it out today? It's been
really
just
wanted to say, amazing session, really good update. I'm glad that we're all kind of seeing things in a very, very similar light in terms of where the markets are. It's just very frustrating right now, because to me, the fundamentals and technicals are just so out of whack, which you see that quite a bit, but not to the degree we're seeing it now. So for anybody who wants to get clarity, highly, highly, highly suggest you guys join the special charter membership. It's $39 for a year. Follow the link below. Get it. It's wealthpress.com tactical. You guys will love it. Get a clear view of how things work. It's money very, very well spent. And I think that the next couple of weeks, we're going to see a lot of earnings and a lot of Fed policy really drive the market to a level of confusion we have not seen in quite some time. So
it's looking through the noise, right, Roger? I mean, there's so much, and I'm sucked into it too, focusing on the next day and the next day and the next day, right? And we're figuring out how to navigate. But when you find opportunities like this, it's a way just to step back and say, all right, I'm going to watch this puck But this puck is going to go a long ways without me having to worry about it, right? No, it was a great read, a tremendous insights. So everybody, I highly recommend you sign up.
Yeah, get with Garrett, guys. This guy's a real bona fide economist. He knows the markets. He understands what's going on, and he's not going to BS you. And that's something that I can't say for the Fed right now. It's very, very different. And Akeem, great analysis on the sectors. Very, very good insight.
Yeah, the only last words I want to say is I especially looked in November and December on the last crashes of the last 70 years. Mm-hmm. And we are in the nearly the same environment as we had in 1982, I think. And especially this 200-day line is so important. And what we see in all these crashes was we need to jump above this 200-day line, and we need to jump above it and stay above it at least several weeks. Yeah, then we might be out of the woods, but we are not out of the woods yet. So it's 50-50 where we go now at the moment. So,
boy, are we back to 1982? That would be. I don't know if the Fed is ready to admit that, ready to open that gate yet. I don't know if we're quite ready for that, but no, that's an interesting the dynamics of an aggressive Fed hike, potential pause, the market's reaction. It is a very similar situation. And the point is, do we think is the Fed Volcker in 79 or Volcker in 72, right? Or in 82, yeah. I mean, in 79 or 82. And, we'll see where that comes out.
I just want to ask one quick question to you, Don, and everyone else is, what happens in Q3 or Q4 if the Fed does pause and then this excess liquidity that we've seen coming into the market then moves into the productive economy and then does, push in the core inflation into 4.5% again? I mean, what is the impact there? And what do you even do in that situation? I think that's the nightmare scenario.
So 100%. So first off, I'm not convinced that inflation is going to settle in here for below. I think there are underlying factors as a result of the most fantastic, incredible money printing campaign ever in the history of the world, right? We didn't solve it with a 400 basis point hike.
No.
So there's this smoldering going on, just like you get forest fire, the firefighters need to go in there and really put it out, right? They put on a lot of water. I think that's where we are. But if the Fed pauses, if the Fed steps back, we are in crack up boom phase, right? The market's going to go nuts. They're going to absolutely love it. Consumers will be falling all over themselves, and there's a genie in the bottle that they have let out. So, and it's a paradoxical one. And this and tell me what you think about this, Garrett. That all that money, the $9 trillion in assets that the Fed built up on their balance sheets, right? Most of the money that went to the banks, it sat in excess reserves. There's like $4 trillion of that just sat in excess reserves. That was the bank's banking account, right? That's the bank's bank account with the Fed not doing anything. $4 trillion, right? And there's no incentive. With the rates so low, there's no incentive to do anything with it, right? That's the liquidity trap. That's pushing on a string that the Fed created. Now that they started to hike rates, all of that reversed. That money's coming out. Consumers are borrowing. Businesses are borrowing. They are paradoxically fueling money velocity, right? By hiking rates. That's the problem that I think they've set for themselves. Plus, you've got just wage pressure going up from baby boomers retiring, right? That is something I didn't, I talked about it in the 20 years ago, forgot about it for 10 years. And now it's we're here, right? I mean, there's 10,000 retiring a day. That's why we've got a 3.5% unemployment rate.
Right.
And we can't get that higher because there's just nobody to let go. So the conditions are way too tight. If the Fed, if the Fed does anything at all and blinks, we're off to the moon. And then they got, who knows how they solve the problem then, right? Which was, that's the Fed in 1979, right? Volcker stepped in, they kind of eased back. It tore up for 2 years. Then the Fed had to hike so aggressively, you had 20% Fed funds rate, mortgage rates at 32%. oil at $10 and my dad out of a job.
That's great analysis.
Anyway, I'm
Yeah,
glad you
it's,
asked that question.
Yeah,
What do
just
you
not.
think,
I'm
Roger?
not seeing any rainbows and you know, fairies and butterflies at the end of this. At the end of this, I'm just not. I'm seeing a lot more pain, and I think every time the market gears up, I'm just seeing the sentiment change, and I'm just thinking, folks, you're not seeing the whole picture. It's just not that great, and I'm not one of those perma bears by any stretch of the imagination. Just the reality right now is just not all that amazing. You know, it's just kind of eh. So, but folks, definitely get with Garrett. Follow that link on the screen. You guys will enjoy it. And what a great session we had.
It was.
Loved it.
Really
Garrett,
getting
great
it,
question
getting
too
deep.
at the
Did
end.
a
I
great
appreciate
job,
it.
Don, of getting all this info from us.
Yeah, Akeem. Hey, thank you very much for dialing in.
Thank you very much, Ding.
All of you guys are great. Everybody, make sure you get that newsletter. Click on that link. I found it very valuable, right? And I'm hard to impress. So, yeah, you guys.
Good stuff. Very good
job.
stuff.
We'll see you guys. And everybody, come back next week for our next roundtable.
And also follow the link if you're watching on YouTube. Make sure you like this channel, subscribe to this channel, and put us and thumbs up. That's right. That's right. Thank you guys. Have a great rest of the week. Thank you, Don, so much. Thank you, Akeem, and thank you, Garrett. And Akeem, I hope we see you again on this session.
Bye,
guys.
You're welcome. See ya. Bye.
Stay safe at 2:00, everybody.
Yeah, don't do anything stupid between now and then.
I'll leave this open for a little bit in case anybody wants to click through. Thanks for joining us today.